Brad Williams, Frugal Finance, cost of equity and hurdle rates. Cost of equity is the rate of return that investors demand to invest in the equity of a company. All of the risk and return models talked about previously require a risk-free rate and a risk premium in the CAPM. We start by talking about those familiar inputs before directing our attention to the evaluation of risk parameters. Risk-free rate, the majority of risk and return models in finance begin with an investment that is identified as risk-free and use the expected return on investment as the risk-free rate. The expected return on risky investments are then evaluated relative to the risk-free rate, with the risk-generating and expected risk premium that is added on to the risk-free rate. Prerequisites for an asset to be risk-free. We identified a risk-free investment as one from which the investor recognizes the expected return with certainty. As a result, for an investment to be risk-free, that is, to have an actual return be equal to the expected return, two conditions have to be met. There has to be a no default risk, which usually means that the investment must be circulated by a government. Note, though, that not all governments are default free, and the existence of governments or sovereign default risk can make it extremely hard to figure out risk-free rates in some currencies. There can be no doubt about reinvestment rates, which means that there are no intermediate cash flows. To demonstrate this example, suppose that you're struggling to figure out the expected return over a 3-year period, and you want a risk-free rate, a 6-month treasury bill rate, although default-free cannot be risk-free because there is the reinvestment risk of not knowing what the bill rate will be in 6 months. Even a 3-year treasury bond is not risk-free, since the coupons on the bond will be reinvested at rates that cannot be calculated today. The risk-free rate for a 3-year time horizon has to be the expected return on a default-free government 3-year zero coupon bond. This obviously has dire consequences for someone doing corporate financial analysis, where expected returns generally need to be projected for extended periods over many years. A stickler's scrutiny of risk-free rates would then involve different risk-free rates for each period and different expected returns. As a sensible concession, however, it is worth recognizing that present value effect of using risk-free rates that can change from year to year tends to be small for most well-behaved term structures. In these cases, we could use a duration matching strategy where the duration of the default-free security used as the risk-free asset is matched up to the duration of the cash flows in the analysis. If, however, there are very large differences in either direction between short-term and long-term rates, it does pay to use your year-specific risk-free rates in computing expected returns. Cash flow and the risk-free rate, the consistency principle. The risk-free rate used to derive the expected return should be calculated consistently with how the cash flows are calculated. If the cash flows are nominal, the risk-free rate should be in the same currency in which the cash flows are estimated. This also means that it is not where a project or firm is located that establishes the picking of a risk-free rate, but the currency in which the cash flows on the project or firm are anticipated. Thus, Granite can look at a future project in Mexico in dollars using dollar discount rate, or in pesos using a peso discount rate. For the former, it would use the U.S. Treasury bond rate as a risk-free rate, but the latter would need a peso risk-free rate. Image 2.1 compares risk-free rates in different currencies in early 2009. Note that if these are truly default-free rates, the number one factor determining the variation between currencies is expected inflation. The risk-free rate in Australian dollars is higher than the risk-free rate in Swiss francs because expected inflation is higher in Australia than in Switzerland. Under conditions of elevated and volatile inflation, valuation is often estimated in real terms. Essentially, this suggests that cash flows are prepared using real growth rates and without allowing for the growth that comes from price inflation. To stay consistent, the discount rates used in these cases must be real discount rates. To get a real expected rate of return, we need to begin with a real risk-free rate. Even though government bills and bonds offer returns that are risk-free in nominal terms, they are not risk-free in real terms because inflation can be unstable. The typical approach of subtracting an expected inflation rate from the nominal interest rate to arrive at a real risk-free rate presents, at best, only an estimate of the real risk-free rate. In the past, there were hardly any traded default-free securities offered to estimate real risk-free rates, but the innovation of inflation index treasuries, called TIPS, has filled this void. An inflation index treasury security does not offer a certain nominal return to buyers, but instead offers a guaranteed real return. In August 21, for instance, the inflation index U.S. 10-year treasury rate was negative 1.016%, radically lower than the nominal 10-year rate of 1.15%. Brad Williams, Frugal Finance. See you soon.